Financial institutions are now leveraged long on the stock market to the highest level since November of 2021. This has huge consequences for the stock market in the near term that we're going to discuss in this video. This is an index that shows us the exposure that fund managers have to the stock market. The closer to zero this is, the less exposure financial institutions have to the market. And when it's at 100%, it means fund managers are fully invested in the stock market. And anything above 100 means that they are leveraged long on the stock market. And that is currently the case. Fund managers are more than fully invested in stock. But it's not just fund managers that are going all in on the market. Average investors are also getting very bullish on stocks today. In fact, they're the most bullish since January of 2022. This is a chart that shows us the percentage of investors that are currently bullish on the stock market, but it is smoothed by 50 days. So this gives you the general trend in investor sentiment over time. And when we add the S&P 500 on top of this chart, we see that the peak in investor sentiment in late 2021 also happens to have coincided with the peak in the stock market in late 2021. Unfortunately for the average investor, they are very poor market timers. Moments where investors are very bearish on the market, like here towards the end of 2022, the end of 2020, or in early 2016 right here. Those were actually great moments to be buying the stock market as the S&P 500 rallied significantly from those levels. And on the flip side, when investors are getting very optimistic on the market, it typically coincides with peaks in the market like here in 2011, in 2015, in 2018, and again in 2021. So does that mean that the stock market is putting a very large peak right now as we speak? Well, something to consider is that this survey was actually at the same level as it is today in March of 2021, and that was right here on the stock market. The S&P 500 continued to rally for almost another year after that. We can say the same thing about investor sentiment here in 2014. Investors were quite optimistic on the market, and the S&P 500 did continue to rally for another year and a half after that. In 2011, sentiment got very bullish right here, and the market only corrected around 6 months later. As a general rule, we can say that when investors are getting optimistic on the market, that's time to think about selling. But we have also seen periods in the past where investors can stay optimistic and the market continued to rally, which is absolutely something that can happen today. On the other hand, fund managers being leveraged long is a warning signal for the near term. You can see this reading right here was in October of 2023. When we add the S&P 500 on top of this chart, we see it coincided almost perfectly with the bottom in the S&P 500. So at a first glance, fund managers are terrible market timers. They were heavily underexposed to the stock market right at the moment where the stock market was bottoming. But fund managers have a history of being underexposed to the market right as the S&P 500 is making a bottom. In fact, since this reading in October, the stock market has rallied 25%, and now they're going leveraged long on the market, probably trying to make up for the underexposure that they had when the rally began. The last time that they were leveraged long to this extent was actually in November of 2021, right as the stock market was making a significant peak before a 25% bear market. So is this reading a signal that the stock market is about to start a 25% drop? Probably not. When we zoom out a little bit on this chart, we see there were multiple periods, for example, in 2020, where fund managers were also leveraged long, and that did not coincide with a peak in the market. They also went leveraged long multiple times in 2016 and 2017, and those readings did not coincide with large tops in the market either. But in the short term, these spikes can be warning signals for the stock market. When we zoom in on 2021, you can see fund managers went leveraged long right here in August of 2020, and that was followed by 10% corrections in the market. They also went leveraged long in January of 2021. That was followed by a 5% correction. They went leveraged long in March of 2021. That was followed by a 5% correction. And in October of last year, these institutions also went leveraged long on the market, and that also coincided with a temporary peak before a 10% correction on the S&P 500. Part of this can be explained simply just by portfolio rebalancing. These money managers, financial institutions make up a significant portion of the market, and so they can have a significant impact on how the market behaves. If most money managers are long on the market, they could decide to reduce their positions tomorrow, and that would drag the market lower. When money managers are underexposed to the market, they could decide to significantly ramp up their investments, and that would lead the market higher. So it's not necessarily that money managers are very poor market timers, but more that when all of them are doing the same thing, they do leave the market vulnerable to some of them changing their minds. Today, money managers have substantially increased their positions in the markets following a significant technical breakout and strong price momentum. If fund managers are not invested during this type of strong market, they'll probably end up losing their clients. Yes, there are signs that a recession is on the horizon. The yield curve that has been inverted for the last year and a half has an almost perfect track record at anticipating economic downturns, and that's because yield curve inversions signal that the Federal Reserve has increased interest rates enough to trigger economic downturns. Now today, despite these very tight conditions, we're not in a recession. When we look at the state of the job market, for example, that typically weakens significantly following yield curve inversions, we've actually seen it be very resilient this time around. So despite these very tight economic conditions that we have today, the labor market hasn't weakened like it usually does, probably because of the significant amount of economic stimulus that we've seen over the last few years. So we're not seeing clear signs that the economy is heading into a recession just yet. The profit margins of S&P 500 companies have increased substantially. These companies have large cash piles following the fiscal stimulus we've seen over the last year. Consumers are still spending. These are the reasons why institutions are leveraged long today. And in addition to that, interest rates have been declining over the last few months. Jerome Powell, the chair of the Federal Reserve, reaffirmed that they will be cutting interest rates in 2024 despite the economy still being very strong and inflation being stubborn. So of course the stock market loved to hear this. The S&P 500 rally that has already been incredibly strong since their announcement in October is beginning to steepen. Ever since the S&P 500 broke out above this head and shoulder bottoming pattern in October, it's been a relentless run with no pullbacks as it inches towards the 6,000 point target that this head and shoulder pattern suggests the S&P 500 could reach. Now we're not looking to participate in this trade right now because the rally is overextended, and as we discussed in this video, institutions are leveraged long, making the market at risk of a quick violent pullback. If one of these factors reverses at one point over the next few weeks, it could lead to a short violent pullback on the S&P 500, and if a recession materializes, it could lead to a much deeper pullback on the S&P 500. Although, as we've discussed in recent videos, we don't think that's going to happen until the second half of 2024. At least that is what we're currently betting on with our members on the website. If you want a membership at a discount, we're currently doing a flash sale on the service for 48 hours. Make sure not to miss it.